two fundamental types of credit: installment and revolving. So we all know installment is that regular term loan for a car, or just anything with a fixed rate, fixed payment, and you're paying principal and interest payments every month for a set period of time, a year, 5 years, 10 years, whatever. You get a lump sum on the front end, and you start paying it back. Whereas revolving is any kind of trade line where you have a certain credit limit, and then you use it as you want to, pay it off, draw from it, pay it off, draw from it, that kind of thing. There's three primary interest rate types: fixed, usually associated with the installment loans. That means it doesn't move. The variable, usually associated with revolving lines of credit, means it goes up and down. It's tied to something like prime or some other rate like LIBOR or that type of thing. And then adjustable. Now, you don't see a lot of adjustables out there. There are adjustable rate mortgages and a few other types of products that are adjustable. And a lot of times, not all the time, but a lot of times those adjustable rate deals start out really low and then they gradually increase over time. And the APR on a loan represents the interest rate plus any fees shown as an annual percentage rate. So this gets confusing for a lot of people too. But if there's no loan fees on a particular credit product, then the APR is exactly the same as the interest rate itself, the underlying interest rate. When there is a fee, then APR is always going to be more than the underlying interest rate. And the two primary types of payments are that amortizing principal and interest, or P&I for short, and interest only, which is usually, if that is an option, it's going to be on those revolving type accounts. And then the term is the length of the loan in months or years. Now, the term of the loan impacts the payment and the total cost. You probably get that, but it's huge, right? And so the term, depending on what you're after, either shorter is better or longer is better. If you want the lowest payment possible, then the longer term is going to give you that. If you want the lowest cost over the course of the loan, the lowest cost, the shorter the term is, that's going to be helping you in that way.
Pinnacle Bank is a member FDIC and an equal housing lender. Neither Pinnacle Bank or its affiliates are a registered broker-dealer. Securities and/or insurance products are not deposits, not insured by the FDIC or any other government agency, nor are they guaranteed by Pinnacle Bank. They are subject to risk and may lose value. Registration does not imply a certain level of skill or training. The purpose of this series is to provide helpful information on the subject matter covered. It is offered with the understanding that Pinnacle Bank is not rendering legal or accounting advice. Since the details of your situation may be fact-dependent, you should additionally seek the services of a competent professional regarding your personal situation.